Hey, welcome back to the Bear Trap Discord podcast. My name is John Kirby. My co-host is Vic. All chart credits, as always, go out to Auk. This episode is actually preparation for an episode that we have coming up with Gamma Edge. And so we wanted to do a refresher on gamma exposure charts. And the cool thing about going back and looking at these things is that when me and Vic, when we sat down together, we realized that there's all sorts of new things that we're always seeing in them. So there's something really nice about going back to basics because more things end up coming out of it. And so hopefully this podcast is a really nice contrast for those of you guys who already know a lot about gamma, hopefully you'll find some useful stuff in here. For those of you guys who are new to it, hopefully this will challenge you a little bit, but also provide you with a way to get started with all these charts. Well, without further ado, I hope you guys enjoy the episode, like, subscribe, etc. All right.
Okay, there we go. Okay, so we're live.
Let's go. Let's do this. So we're gonna we back once again, of course, Bear Trap Discord, but we're gonna talk about these charts here because these explanations here. I don't know. These are just perfect. Okay, to go over. So where do you want to start, John?
I actually wanted to ask you. So you were a trader before GEX, before Gamma Exposure. How did it change the way you look at price action and the way that you approach trades? And how big of a difference has it made?
Very, very good question, because the one thing is playing the edges and knowing how far a stock can move. That right there already is going to be like that already there is an insane edge as a trader. So using GEX to just know, like, it's very unlikely for price to go here. It's very unlikely for price to go here. And you can narrow it down to the point to where you're like, well, the most likely scenario on the distribution is going to be here, just based on everybody's betting positions and the time they have until they expire. So, you're looking at the GEX, you don't even need an indicator to trade options anyways. Like if you're going to go trade futures with the GEX, you should probably have like a moving average or something, I think. But it's like, so yeah, what about you? What did it do for you? You're an indicator-based trader, I think, before this.
Yeah, I mean, I was mostly a volatility-based trader, so I would just look at, implied versus realized volatility, do mean reversion and vol, that type of thing. And this completely changed my understanding of how markets move. So I came into the markets thinking, as most people think, that they're random, right? And to some extent they are. And it's almost like markets are random relative to the model of markets that most people have in their head. But when you start to see gamma exposure, meaning like you start to see how people are positioned in the options market before the price action of a given day, and then you see the results of that day, you start to realize that it's not as random as you thought it was. Is that fair?
No, and you're totally, I mean, it's still random, like you're saying, but the distribution isn't that hard to see. The probabilities aren't that hard to play, essentially. It's not like it's not super easy to play to basically call the next day's action, but it's way easier using this.
And all of a sudden movements that are inexplicable to a lot of people. I remember a while back we had an FOMC conference with a surprise hike, and then we rallied off it. And I had a buddy who was completely confused as to why something like that would happen. And I remember I had listened to a GEM podcast beforehand. I was watching the GEX, and I could see just by way of the way we were positioned in terms of options that something like that had to happen. So it makes the market and the moves that happen in the market actually make sense rather than feel arbitrary.
No, and the other thing too is knowing the different environment that you're in based on this helps you as well, because one, you're seeing the edges, you're seeing the tails, which is that eliminates a lot of the price action already. That's not going to happen. So now you have a better window of where price can trade. And then you can also, sorry, I lost my train of thought there. Hold on a second. What was I saying?
Well, you were saying that there's
play the edges, and then what's the other part that I was trying to talk about?
Well, it tells you the edges, and it also tells you how price is going to trade, right? Like if it's going to squeeze, if it's going to just
correct the environment,
bounce around. The environment,
the environment that you're going to be in. Are you going to be buying the dips, or are you going to be playing? Is it going to be a choppy day? Which is the most important thing to me. Is it going to be a choppy day, dude? I want to eliminate. That's the first thing I go into every day. Is like, hey, is this choppy garbage day, or are we going to actually get some trend action? And so right there, like 80% of the time, the markets are already choppy anyway. So you just eliminate 80% of the trades that you're not going to take now because of that. So it's like playing.
And for me, it's the opposite.
Playing
right? Like I look for those setups where it's going to create a choppy day, and then I try to collar in the price, right?
So there you go. Yeah. So if you like that kind of action, that kind of action gets you 80% of the trading action. So, if you like to trade every single day, boom, there you go. We got traders, like Doc, who he literally just comes into the market every day and sells the edges, credit spreads, right? And then just, dude, it's like clockwork for him. I see him
100%.
in his trades. So if you're a day trader and that's basically all you need to do is come in here and play, like in this particular chart's case, you basically come in here and you can sell the 428s, 429s, 430s. You're probably going to collect some good premium off of that. You know what I mean? So that's it. Then you're done, and you don't have to look at indicators. You don't need to look at anything else, except for maybe having like the volatility trigger on your chart or something. So it's like, how it changes you. So the trading environment. So now you can have multiple strategies for every environment that you want to use, and basically, what was the other thing? It was telling you, the probability distribution. So two things right there are going to give you massive edge.
Yeah. And so let's actually break down. So I think we have a good teaser on like why this is important, why people should be paying attention to this. And that's something that at the end of the day, you're going to have to see, right? You're going to have to look at these charts, understand them, and then look at the price action and compare. So that's not something we can do for you. But if you've been listening to the podcast over these last few episodes, you probably have a pretty decent indication that this works. But I just wanted to go into why it works, and it's pretty simple. It's just a little bit ago, Vic said, this is telling you the distribution of bets, right? And so, right on really simply, most people listening to this will already know this, but on the left-hand side here in the yellow, we have the call options, or call gamma actually, and then down here we have put options, or put gamma, negative gamma, we call it sometimes. And this is a way of basically taking all of the bets that are at each of these strikes and then netting them out, figuring out like whether there's more to one side, more to the other side. And then what these things will end up doing is, at least on the call side, for instance, these will act as accelerants to price. So if we get above this one, then it's likely that we're going to go to this one. It's likely that we're going to go to this one, likely that we're going to go to the next one. The reason for that is because somebody's selling these bets. And when you sell an option, most people are aware that's a more significant liability than when you buy an option. You buy an option for, $2, fine, you can lose $200. If you sold that option, right, and it goes against you, you could lose technically an infinite amount of money, meaning that sellers of options are more likely to be trying to hedge them out. And so that's why we look at this. It's because we know that there's somebody on the other side that is worried about these options, that's trying to hedge them to the other side. And the only way that they can hedge them is by hedging deltas. In other words, if we get above this wall of call options, they're going to have to be buying shares, and that's going to keep pushing price up. And the dynamics are similar with put options, slightly more complicated. But those are the sort of fundamentals. I mean, we'll link in the description a lot of sort of that explain a little bit more why this works. But that's the basics that we're starting with.
That was a great explanation, dude. And so that's the basics of using essentially the histogram. Okay, so that's going to be one part of it, and the other part is going to be able to be incorporating those lines as accelerants, like he said. Highlight that delta line there. One way I use this, and you'll see the gamma sort of fill in.
This line right here.
Yeah, it's hard to see. One thing you'll see with these lines is this is basically giving you the range for the day, in my opinion. and highlight the one on the put side as well.
Oh
dear. Oh boy.
Well, you guys get the
bear
idea
trap
of
technology here.
Yeah.
Okay, so let's see here. No, that's perfect. Okay, they get the idea. I mean, if anybody's watching this and with me so far, but that, so essentially you're looking at, he's talking about, you hit one of these gamma bars and you're likely going to get some hedging pressure to the next one, right? And it's going to sort of try to be attracted towards that the biggest one, depending on which side of the gamma you are.
These lines reflect how much hedging pressure there's going to be at each point along this line.
And so, but that's the delta curve. So that's going to be giving you essentially the probability distribution right there from the option market's perspective. Now that line is going to shift. In my opinion, it shifts based on the IV. So now you got three parts to this, where you've got the histogram, and then you've got that delta line there, and then you've got the IV, which is these red lines here in the middle.
Yeah,
those guys.
It's the red shaded area, right? And you can see, those of you who are familiar with IV and the smile or smirk of IV, we had a whole episode on skew. It's right here. It's right here along the line, except here you can really see it sort of mapped onto the gamma, which is beautiful, right? Because you can see that the lowest here, right? Like, what is the local minimum of the vol curve? And it's right here at these 425s. So you can tell, hey, like, those are pretty popular. These are pretty expensive, but they were being bought anyway, the 422s on this particular day. We don't even care what day it is, right? We're just looking at this chart for educational purposes. But,
correct. Yeah. No, that's perfect. And so you see this little zone, like if I'm looking at this and I'm going, okay, we're going to 425. Like, it's not even hard for me to tell at this point, because you see where he's talking about this curve in the IV. That's the low point. Price is naturally going to be, people are going to sell both sides of the skew because that's what you're looking at. In general, they're going to be selling the higher strikes first, and then buying the higher IV, and then buying the low IV. So you're naturally going to, gravitate towards that low trough he's talking about here. That local low point on the IV. So like on the call side, you've got that around at 423, 424. That's where all the people are positioning their bets, because that's where it's cheap, at least on this side, at least on this side of positive gamma. And so if you've got the low IV, and then you've even got the trough there, then you're likely seeing 425 in the near term, at least for at least a tag, I would say. And then it's within the delta distribution, because like if you're up at 430, you can see people making bets there, but look at the delta. The deltas are really small there. So is there going to be a lot of hedging pressure, delta hedging pressure, until price can get up anywhere nearby? But then you've got,
it's almost like the I've tweeted this before, because I actually think about it this way. It's almost like the air gets thinner and thinner and thinner and thinner.
Correct.
Right?
Yeah, that's a great way to put it. And so theta is going to kill that stuff early. I think maybe we should add a theta curve to these charts, dude. But because that would give us an idea of the charm effects.
Yeah, but, I mean, right now, the way that this works, right, because we're talking about 0 DTE options here, which means that theta is actually really relevant, because I mean, theta is relevant for all options, but it's super relevant here because every half hour that passes, you're going to have an effect where the gamma on some of these is going to increase, and the gamma on other ones is going to decrease radically. And there's more gamma that's going to evaporate from the picture, because think about it in terms of what the option values are doing. And we all know that most option values over the course of the day go to 0, right? There's only about half of them, or whatever, that are going to be worth anything by the end of the day. There's another half of them that are going to be worth nothing. So net, we're losing a lot of value by the end of the day in theta.
Okay, so and like in this chart's case, you've got the put GEX as well. So you've got put gamma at the bottom there, which is also, basically they're diminishing the probabilities. They need a delta hedge against those as time passes at an accelerated rate. We don't know what the rate is because we can't see it here, but so that's like the fourth part of this, where you've got to kind of make assumptions based on charm or time effects on gamma. So
and that, I mean, that's what I do. Like, that's what I kind of have been specializing in, right? Where I'll look at these, and just to break down a thought process, doesn't have to be super complicated. I'm looking at this put wall here, right? I'm saying, okay, by the end of the day, so long as by the middle of the day price is still above 420, these guys are going to be radically reduced in value, meaning that these as a hedging liability are going to reduce in
So that's
importance.
interesting because it's like you're taking and you're using your experience in that, like, fourth part of this here, where you're looking at the histogram, you're looking at the delta curve, you're looking at the IV, and then you're thinking about charm.
Exactly. That's
that's
how I
where
make
your
my
experience
projections for the
comes
end
in.
of the day.
Yeah. And so I'm saying, if we add a line to this, if there's a way to add like a visual for that, so you can see the impact of it, because I've seen where, it depends on how bearish people are. People will hold on to that GEX for a while. I mean, as far as they won't hedge against that or release their hedges against it until later on in the day. You know what I mean? So like if someone's like, oh, I need to get rid of these, these short futures here and buy them back, they might not do that until the theta kicks in on those puts they sold.
Yeah, and I mean, sometimes it'll take a little bit. It kind of depends on the structure of that day, right? Because not all theta is created equal.
Exactly. So yeah, I'm just saying, it's like, this is the part where you use your experience, what kind of day it is and stuff like that, to make that assumption, because that's not on the chart.
But the way that type of thing works is it's just a series of if-then connections, right? Where I'm saying, hey, like, if price is above here by this time, these guys are going to go away, which is actually going to push price up, a couple points at least, because these have gone away. And then these guys, if we're close to them, are actually going to increase in relevance, which is going to actually increase the hedging obligation right here, meaning that our most likely endpoint is actually above the 424 and not right at 424.
Yeah.
Right. And so you start to use your experience to start to see how, if time is going to collapse the value of some of these options and expand the value of other options, it's going to modify the delta hedging curve over the course of the day.
The delta hedging curve is the key, because that's where you can see if that thing starts to shrink, what's it going to collapse around, essentially.
Exactly. Yeah.
What's it going to collapse around? And it's usually the peak. It's usually the peak GEX, depending on what time of day it is. But if you look at this and you see 422 like this, you're like, this is probably closing around 422. It's not that hard. Or somewhere between 422 and like 424. I could see, like, in a chart like this where they try to let those 425s also expire, but because the market's like that, especially with the low vol. The other thing is, if you got low vol,
it's going to depend on context, right? Like, if this were in an environment like we have right now, or like we had last week, I would say, yeah, we're hitting that 425. If it's in an environment like we're going to have in this coming week, I'd say, yeah, they're probably going to park it around 423.
Well, that's the IV assumption you make too, because the IV, is there enough juice really to get up there with the IV where it is? You'd have to kind of just make that assumption based on what you're looking at there, because it says there's the IV and historical vol indicators. So
yeah,
that's super useful on trying to decide on, hey, is IV still elevated here? And if it is, why is it remaining elevated? And then you can look for risk points, maybe to get short.
The reason that's elevated, to go back to our discussion on skew, is because if we're thinking about IV as a supply and demand issue, if IV is elevated, it means that there are more people out there that are looking to buy options.
Right, exactly.
Regardless of what those options are, meaning that if we do get up, it's very likely that those people will start to purchase more options up higher, which is likely to force us even higher up. So it almost is like, it tells you how much momentum there is in the market or in the options market.
It's a volume indicator. Volume and volatility very correlated. And 100%. So like if you look at volume for futures, you're looking at like a footprint chart or something. You're reading the volume on the bid and the ask or whatever. That's just basically volatility.
Yes.
And how much momentum. So, looking at something like this, you're going, hey, we're still kind of elevated. And that's really just because of the IV 30s and your HV 30, even going out to the 90. I mean, hey, you're trading at the 90-day right now. I mean, that's kind of high. You can start making assumptions like, well, the market could probably expand more than I'm thinking. That 425 would definitely be a possibility. As IV contracts,
that's where I like
it's really going to move.
Sigmas.
Yep.
Yeah. Right, because this, sorry to interrupt, but this
fine.
August 12th Sigma, this is basically telling us, what did the option market price in at the beginning of the day for the move by the end of the day? And right, it's basically saying, hey, these 425s are outside of the expected range. And this is one Sigma, right, which is what, like 68% chance or something like that. So it's not saying we can't hit that 425.
Yeah.
It's just saying the option market thinks this. And so if you were to, let's say you want to go out and see if it makes sense to buy these 425s, the only case in which I would do something like that is if you see a ton of puts down here, which are going to come off, which are going to push us up, and then you have this sort of a better laddering, and so you can kind of hypothesize that the options market is not pricing in the sort of chain reaction that's going to happen that would actually take us above this 424. Otherwise, buying those 425s is a waste of your money.
Right. Yeah. And then, and if you're a seller, then you're coming in, if you make those assumptions and you're going, yeah, 425's not in the cards today, hey, you got some decent premium on the IV for those if you're a call seller. But you're more likely a put seller here in this case, but because you still got some IV down there, much lower. The other thing too is I was always wondering what this max pain has to do with this chart, and I'm starting to get ideas based on this. I want to know what you think first on max pain.
Oh yeah, I can tell you. So how I was saying before that by the end of the day, like half of the options have to be worthless.
Correct. Yep. Mm-hmm.
The reason I said half, and that's not actually accurate, right? It really depends on what the histogram says. But by half, I just mean half the strikes, right? So if we're at a very particular point, then half the strikes are going to be above, half the strikes are going to be below, assuming that every strike has an equal OI, half of them are going to be useless. The reality is that we have this histogram, which means that we have more call options right now, for instance, than we have put options. So it's no surprise that max pain is all the way down here, because the most option holders would lose the most money if we were to expire down a little bit underneath all these calls, because then all these calls would be worthless. So the max pain is sort of the equilibrium point. The question is, at expiry, what is the price at which, if we were to expire, the cumulative option holder would lose the most money?
And that's based on OI.
Correct. Yeah.
So the way I was thinking of it is similar to you, and we just have different ways of saying it, I think. But basically, you're using that like a pivot point. Like, for example, right now, max pain is 414 for everybody, but it's like all the puts are dying, basically, is the way I look at it. I'm looking at it sort of like a midpoint, but am I wrong in thinking that?
As a midpoint? I mean, I don't know that I even see any use to max pain, because
I'm just trying to think about how to use it in a trading context as far as an environment, maybe like a fifth confirmation of environment, is if we're above max pain, that means the bulls are essentially in control.
Yeah, that's right to me.
Because if you look at a max pain chart, I'm going to send you this. If you look at a max pain chart on unusual whales, and I think everybody should be able to look at this, but I'm going to pull it up here. Which
I used to look at those before when over the summer I was using UW.
Yeah, and they've got a good Greek page. But let me look at max pain here for. Yeah, so it's basically saying, hey, look, call pain. Yeah, call pain is like right now for SPY. I don't know if this is real or not, dude, but yeah, it's not. Okay. Anyways, like you look at the chart, and it's basically telling you who's in control based on where price is. And that's the one thing I always want to make sure to emphasize is none of this stuff matters unless price is on your side as far as this goes, because the price is what's determining everything else. So never forget that.
And this is something that I was listening to one of those to a Gamma Edge video, and I think one of the analogies was actually really quite pertinent that Paul was using, and it was that price is like the flashlight in the forest of gamma exposure, meaning that it's almost like if the price moves up, then you're all of a sudden going to see some gamma come out of the woodwork, so to speak, that you didn't really know was there. And the reason for that is really simple. It has to do with the same hedging liabilities I was talking about. Max gamma for an option is when that option is literally at the money. That's where you have the most gamma. And the reason for that is, think about it from the other side. If I'm selling you an at the money option, then that is the point at which that option has maximum convexity. Convexity means that you will get more bang for your buck. because it will have exponential growth from there.
Right.
And so the place at which an option is the most dangerous for the seller of that option is when that option is right at the money. So as the spot price moves up or down and starts to hit some of these big bars, the gamma of those bars actually increases, and the gamma of the bars further away decreases. That's why there's two things that are happening at the same time here. One is we're causing changes in gamma by moving spot price over the course of the day.
Yep.
And two is we're causing changes in gamma by moving time over the course of the day. The second is inevitable. The first is random.
Yeah. Yeah. And that's such a good point too. I love the way he describes this, the flashlight. And that makes sense because, the GEX affects the price, but the price also affects the GEX. So that's reflexivity, right?
Yeah.
That's your reflexivity that you're playing off of.
On top of that, because we're out there and we're watching the GEX, like, hey, like if all of a sudden we burst through 423 and we have momentum, I'm like, oh, wow, these 425s are looking juicy. I start to pile in. Everybody else starts to pile into those. Not only is the gamma of the 425s that are already there increasing, but all of a sudden people are buying more of them, which is further increasing the gamma, right? So you have this additional layer of reflexivity because of that.
Yep. No, yeah, and that's the gamma squeeze right there in a nutshell, folks. Let's see here. So that right there is what I was kind of thinking of it as, like, okay, 398 max pain for, say it was Friday, okay. Basically all they did was keep the price above 398 all day long.
Yeah.
Right. So bulls are in control the whole time. And I'm not sure if I'm reading it right, but that's just the way I've been using it. Is like, hey, this is a flip point to where it's like bears, they're not feeling as much pain anymore because they're under here. Just as a data point, essentially. Just going like, hey, that's just one. Hey, if we're really far under there, then things are really bearish.
Well, it's honestly, actually, I think I have another way to describe this based on what you've been saying. So if our volatility trigger is the point at which gamma is going to flip from net positive to net negative,
right?
Then max pain is the point at which gamma at expiry would flip from net positive to net negative.
At expiry, I see what you're saying. Yeah. So, but okay. So that's good to know then. It's more important at expiry then. It's going to make more sense. You're going to give it more weighting as time goes on.
Yeah, I think
because that gamma is going to make much more sense. So let's just run through a scenario real quick. Tomorrow we open up. Okay, we got 398 right now. Let's just assume it's 398 tomorrow. We open up, 402 SPY. Right, vol trigger is what, 398. Max pain's 398. You got a huge GEX, positive GEX at 400. This is what I haven't even looked at it yet. I'm assuming that's what it is.
Yeah, let's just make it up. All right.
Well, I've looked at it so many times. That's what I think of right now.
Okay.
Here, let's look at it. Because it's like, if I'm going to go into it, I guess I might as well. Here's the most recent one from Friday. The net GEX. This is why it's such a simple look. That's why I already know what it looks like. But
oh yeah, 402. By the way, guys, these this green and red, these are the options market expected moves for the week. So this coming week, we're looking at a top of the range is 410, 410.82 on SPY. Bottom of the range looks like 394.04.
Yeah. You say 403 and 394. That sounds about right.
410 and 394.
Oh, 410. Holy smokes, bro. Okay, let me send this over to you.
Well, but, I know that my description of max pain probably was not the most useful.
No, you're fine. No, it made sense, man. You connected something for me, so thank you. It made sense that it's more impactful at expiry. So knowing where that is, knowing that the market is essentially in a weak way, in my opinion, it's trying to get to max pain just because, obviously the market likes to screw the most people possible. But it's kind of doesn't work all the time. It's very rare, but
that's exactly how I'd formulate it. It's always trying to get to max pain, but usually gamma levels get in the way first.
That's a good way to put it too. Yeah, it's like you can't really get there if gamma and the delta distributions aren't positioned for it. So it's like then you can kind of already see. So there you go. So now you can already see, the market is trying to screw this set of people. Basically, anybody below max pain, you can likely think is going to be puts. Right?
Yeah.
What is max pain anyways? How do you even calculate this? I got to know this, man, because if it is the way I think it is, then that's the way that you should describe it then from now on.
It's just what I said, man. I think it's like how are the most people going to lose the most money?
I know, but how is it calculated though? That's what I'm going to look up real quick. But yeah, keep talking about this chart here. So yeah, we were talking about 404. Say we open up here. Say we open up at 402. That's above a wall, a trigger, and max pain. If you were thinking of it like that, if you're looking at max pain for tomorrow being 398. You basically would have to break all that support first. Now, is there a case for that? That's the next question. If they wanted to screw the most people possible tomorrow, then, do we see it in the chart?
If they want to screw the most people possible, then we're going to be around the 380 zone. But that's not going to happen anytime soon.
You say the 380s? Oh, by tomorrow? I'm just talking about tomorrow. Yeah,
no,
maybe
yeah,
by.
But you gave me a net GEX, right? So I was looking at next, right? If we're talking net GEX by whatever the next monthly December 16th, then we're looking at 380.
Well, that's a good data point. Anyways, if you're looking out at a different expiry, what expiry are you looking out at? 98 days.
Yeah. Because this is, but if we're just looking at November 28th,
just tomorrow, yeah.
Then things change a little bit. The first thing I do when I look at one of these net GEX charts, by the way, is that, right, I'll look down here and see, okay, what percent of the total gamma do we have? And then also what's our cumulative gamma number here? So it looks like 88 million in notional value or 88 million in positive gamma. And then it's 10% of the overall options, and then put call ratio, also relevant typically, is 1.42, which is low for the current market, or at least the last few months.
So yeah, it's interesting. It's 10% of all options over 98 days, but then there's only 2% of those expiring tomorrow. So it's interesting how that plays out. So there's a lot more positive gamma for a smaller amount of put call ratio. Is that basically what I'm understanding here? Because I didn't know that 10% meant of all options.
It is so the way that when I talked to Ak about this, what he said is that this is so like if we're looking at 98 days worth of gamma, and we sum it all up, and then this just tells us what proportion is on each day. Sorry about that.
I know, but see, that number never adds up because if you look at December 16th, it shows a 29% number. But there's only 56 million of gamma there. Doesn't make sense to me. If there's only 56, so it's total gamma.
No, 56. So that's something different, right? Because this is total. Yeah, this is total gamma, both positive and negative, expiring.
Gotcha.
10%, and this is just if you were to net out the gamma.
It's just
on
the
that
net.
Day.
Okay. Cool. Yeah, that makes sense. So yeah, 10% of total gamma is basically what it is. Then not total options.
Yeah, and this
total
is what is
gamma.
This is SPY, right? Okay.
So 10% of total gamma on 2% of total options expiring as of the morning, because that's what that next to that put call ratio is saying, right? That's total open interest expiring. So it's 10% gamma, total gamma on 2% of total open interest.
And I mean that's because we have a ton of open interest that is way out of the money nowadays, which is
well, no, if you look down at the other expiries, you've got a 37%er and you've got a 23%er. So you got 37%, 23%. So a lot of the open interest over the next 98 days is expiring at other days, but 10% of the gamma is expiring tomorrow.
Yeah, and that's normal because that's right, like gamma has so much to do with how close those options, how relevant those options are for hedging, that the further away in time those options are, the less gamma relevant they are. Meaning that open interest is sort of this normalized thing where it's just a question of, oh, okay, how many options are there? Gamma is really a question of how much of an effect are those options having? And so
Sure.
being short dated
I
makes
agree,
them
but
much more
here's
powerful.
what is the reason behind there being more gamma here tomorrow versus say on Tuesday or even on Wednesday, which is Chow speaking.
So for the reason for there being more on Monday, well, typically there's more on Mondays, Wednesdays, and Fridays, just because historically, right,
Nice.
those were the
Good.
weekly expiries.
Mm-hmm.
And even though we have very recently moved into expiries on Tuesdays and Thursdays,
Yep.
first in SPX, then in SPY, people aren't using those as much, and so we're still really used to this routine. So there's more liquidity on Mondays, Wednesdays, and
More
Fridays.
liquidity. That's sort of what I was getting to in the end, but you covered a lot of good stuff there too. But the real thing is to know when things can happen.
Yeah.
Like more things can happen, because like if you're trying to play for Tuesday, it doesn't look like it's gonna like anything's gonna happen on Tuesday, which is going to be the November 29th. Yeah, I mean, like you said, there's reasons behind that too as well. But I was thinking more along the lines of like, what about coming off the holiday? Does that have any effect on it as well? Or
that's a good question. And I guess also if you're just looking at this, it seems like you mentioned JPOW. It seems like nobody cares.
It's on the 30th, and so, but even so, it's like you're looking at, okay, we just came off the holiday. Mondays are typically the days where you get higher gamma because of those reasons, and then but you're looking out at Wednesday, and there's only 6%.
Yeah,
that's not for a JPOW talk. Into end of month as well. I mean, you get the end of month flows, which I don't know what the rebalancing looks like for that, but it doesn't look like to me like anything big is about to happen into the end of the month, even with JPOW. If that is the case, then you're likely to see some more VIX destruction. That's what I'm thinking.
And I mean, part of that has to do with seasonality. And I think I'm not sure if I think I retweeted something about this, but right, do you see how low those VIX futures are for December versus January?
Right. Yeah. Mm-hmm. Yep.
And it's just because that's just a seasonal thing. It's like the entire market is used to having this really intense backwardation during this period because it's holidays, nothing happens.
Yep. Yeah, it's reflecting just the market psychology. So you got the seasonality built in here where it's like I'm not really seeing much action planned. Even given that I guess there wasn't a lot of time given because it was an unscheduled talk. I think you're going to have one of those. I think you're going to have VIX crush, or you're going to see a crater of epic proportions. So it's like one of two things. I know it's hard to say, but it's like it's an extremely binary event in my opinion.
I'm gonna take the other end of that and say that nothing happens.
Nothing happens. You could definitely make the case here, and I would lean towards that. Okay, because it's easier to lean towards the upside anyways. Because
here's the other thing. Like I think they know, we're not in a period of particularly high liquidity. So the equities are getting a little overextended, but this might not be the best time to. Then again, I don't know.
I agree. It doesn't. None of that matters. They're not in control of it. You can't make that assumption that they're controlling it. I'm saying, like, think about this. If Powell comes out and he has an unscheduled talk at the end of the month, okay, and you haven't had people haven't had enough time to really plan for it. Because like if you think about most of his talks are scheduled out a year in advance almost, it seems like. So it's like people are hedged for it 6 months, 3 months beforehand.
Yeah.
So the positioning is already there. It's already accounting for that scenario. In this case, people didn't really have a lot of time, especially with the holidays. You had a shortened holiday, you had low liquidity, and I think that's going to be a really interesting number going forward to see how, like, say tomorrow, people start playing for it.
Well, what I'm going to do is tomorrow I'll start looking at the skew and I'll start looking at how IV changes to see if it's actually going to be an event. Because it's also sometimes like we have these guys they'll talk at events that are not particularly FOMC relevant events, and then it's only like 1 out of every 5 times that one of those events actually makes something happen because they're purposefully avoiding any terminology that has to do with rate hikes.
Mm-hmm.
But Yeah, we'll see. We'll see it in the sort of how options start to move.
So this is another way. Going back to the question you first asked, is how has this changed the way you trade? Coming from everybody starts off as an indicator trader, and it's like, well, now you're able to look out into the future in a way, right? Like we're looking out at Wednesday, and we're seeing that nobody's thinking about, people are hedged because you can see 4% of the puts. Or 4% of the option open interest is mostly in puts. So that's an interesting data point. But given that there's no gamma, not really any gamma, 6%. I mean, that's nothing. Anyway, so now we can kind of make some assumptions based on this event, because we're able to see the positioning.
Yeah, that's a really good case study. And then when I think about positioning for the longer term, I'll look out at these sigmas and these delta hedging curves, and this is what's nice about these net GEX charts, right? We have all the different expiries on here, and so you can start to look out even further. Of course, you should probably check in every once in a while because this landscape can change pretty dramatically, especially lately. But
well, and that's the thing about looking at it over time too. You have to look at it, and what I would do for the longest time is I would track it every day, because like I would write down the changes in these boxes down here every day, and certain expiries, and I would just track them and see the difference. And you can gain a lot of really good insight by seeing the changes in each of these different data sets over time. And if you just look at it in the morning, once open interest, you get the updated open interest numbers, and then you look at it once at close, and you can see how it changes. You're basically looking at the price chart of, like, say 4 or 5 expiries having to do with gamma and put call and open interest changes.
Yeah.
So you're seeing the changes and the effects of everybody's positioning over time. Super, super helpful to do that, but it is time consuming, so I don't do it.
When is the you said JPOW was the 30th, right?
JPOW is the 30th, yep. And then you got beginning of month flows coming in, which are typically bullish, and you can see the positioning there is bullish. But
you can kind of see it a little bit, right? I mean, it's just barely there, but here the sigma for November 28th is God, why do I keep clicking this button? Is 0.09.
That's super interesting.
We have a 0.02% increase for the 29th, but then we have a 0.03% increase into the Wednesday, which is this 0.14. So yeah. I mean, a little bit's already starting to get built in there. It's going to take a little more, obviously.
Right. But there's no gamma positioning. I mean, relative to the amount of open interest, you got 10% tomorrow and 2% of the open interest, and then you got 6% on Wednesday, end of month with JPOW, and 4%. You have 100% more open interest expiring, and half the gamma. So, and as far as IV goes, I mean, you're looking at a 14. What's the VIX right now? What's the 9-day right now? 9-day is like 18 or 19.
Yeah.
So it's still extremely cheap, just relative to just the VIX. And so, looking at the skews and looking at, and I bet you if you look at the skew for that day, it's probably well below historical volatility. So it's extremely low. That's what I'm saying, as far as, like, if there's going to be a crater, if J. Powell does his thing where he comes out and he goes, yeah, screw you all, we're actually going to, take this into recession no matter what, that's basically how he talks. And then you're going to see a crater, dude. And it doesn't matter that it craters, because all the open interest that matters is way, way down. You're not going to see that kind of move. But, going back to 390 would not be a surprise to me.
No, I agree. I personally think that the reason that we're seeing this positioning is because nobody thinks that that's going to happen.
I agree too. I agree with that, because that is going to be the most likely scenario. I'm saying that if he comes out, I would own the tails into the event effectively. So I would look at the GEX and go, okay, wow, the tails are where? And if we look at it, pull it up real quick. Where are the tails at here? Let's see.
Do you want because I have a net GEX that's like 100 strikes that I
just look at it. It doesn't. Yeah, I just want tomorrow's really. I was trying to pull it up, or Wednesdays, so that'd be GEX 3.
But the other thing I wanted to mention is that
you come in here, you buy the 390s, is what I'm saying, or 392s or something. You probably make money.
The reason that everything is so screwed right now is because people are in either two categories. Either they had bought protection and they were in this bucket of people who had 360s, right?
Yep.
And they've now gotten screwed, and they now no longer want to buy protection, and so they're losing money.
Yep.
Or they're in the bucket of people that's buying protection for February and March, and skipping the whole December business.
No, I think they're doing that. I think they are for sure, 100%, no doubt in my mind. And I could show it to you, but I'm not going to. But yeah, I think they are, man. I think they're buying.
Yeah, we don't want to rob ourselves of the material for the upcoming podcast. But,
well, okay, so you're totally right. And why are they doing that though? Why are they buying it? Because like you said, all the puts that they bought earlier are all dying. So it's like, well, frick, I thought I bought those, with enough time on them, so now they're going out to February.
And you want to skip over the whole seasonality issue, which is why we're seeing, I feel like, I honestly can't say that I have enough experience to know if this is a very intense backwardation for this particular time of the year.
Right.
But I would guess that it is.
Yeah.
if I had to.
Yeah. No, given what has happened over the course of, the last couple of years, it actually doesn't really surprise me that much because of how many puts are dying effectively because of all the volatility that we've already had. Yeah. So it makes sense that people are, like you're saying, just saying, screw December, I'm not touching it, and I'm going to February.
Because they're still stuck in the same stupid pattern, which is what I was texting you about last night. Like, they're thinking, oh, we need more time on our hedges for the hedges to work. And I'm like, since when has this market given you any indication that that's how hedges work?
And they have not been working that way. And but here's the other side of the coin is that, we're basically, this little cycle here is so important because it's like ending the cycle of rate hike fear. It's ending the cycle of inflation fear, and it's starting the cycle of recession fear.
Yeah.
And so, but here's the thing: everybody was hedged for inflation fear. Everybody was hedged for, basically Ukraine-Russia war. Everybody was hedged for, rate hikes. And so all of that stuff is coming off. It's like all just being shed, and you got not as many people, I don't think, getting positioned for recession fear.
You're right. That is the narrative transition shift. And the paradoxical thing is that with all these other events, with the inflation and the Ukraine fears, the idea was we're going to get these massive moves, and that's why I want to be in puts. And instead, we got this grind down. And now with the recession fears, everyone's thinking, oh, I have time, right? Like, this isn't one of those things that comes on all of a sudden. It sort of comes on in little chunks, but the reality is we're probably going to sell off real hard at some point.
Yeah, and that's what people, I think, are thinking for February. I think that's why they're buying February's, because they're going, I know it's coming first quarter, and it's likely going to happen before March. Just like how it always happens, just like with COVID. It's like the positioning is all, rearranged for the beginning of the year. That's when the crater happens. Everybody thought it was going to happen in the fall or into the end of the year. Instead, you get the rally into the end of the year. And it's just like, it's always the perfect setup, dude. So, and nobody's going to be ready for it again. I don't think it's going to be like, if there is a crash, if it does happen, this is what I'm planning for, then it's probably not going to be as bad as COVID. Unless it's like something really crazy happens. But I think it'll still be a sell-off.
It could last a lot longer, and we're not going to bounce back as fast.
So yes, that's a good way to put it. Yeah, it's not going to be like a 1 month wonder type of thing. It's going to be like, into the summer. I think it would be like a 3 month thing.
But what about the outside cases? Like, what if? Okay, like let's say that J Powell does come out, say something crazy. All of a sudden, we sell off a ton. All these people have these puts that are all the way out in February or whatever.
Yeah.
You think it gets bought back out? Okay.
It gets bought. Like if J-Powell comes out Wednesday, you mean, and craters us to 390, buy it.
Yeah.
I mean, it doesn't make any sense not to buy it unless he says something crazy off the wall, but he's likely to come in and stay hawk And so here's your risk reward there too. He's likely to come out and say hawk. That's probably expected. That's probably why we're seeing the positioning we're seeing, because people are like, well, he does this song and dance where he comes in hawk, everybody's all bullish, he can pivot, and then he comes in and squashes the idea. But is the third time a charm, really? How many times does that happen?
And we have the minutes now. We have the minutes from the last meeting telling
us. Yeah, we saw the meeting.
Yeah.
When the market's pricing in 50 basis points. What if he comes in and goes, yeah, that's pretty much right?
Okay.
I think we go to like 409. So fast. So, and then what happens? Say 409 clicks. I mean, are we really selling off?
No, you're right. The only case in which we do get the surprise is if he comes out and he says, "Oh yeah, no, we're gonna do 75 at the next one." In which case, I'm just interested in that puzzle of, even though I don't think it's gonna happen, what would happen if we cratered sufficiently far, 380, right? And then all of these people have these hedges that are way far out. Those 360s are not close enough to the money to get monetized.
You still buy it because I don't know. In my opinion, you still buy it. One, because I read something the other day about how folks haven't panic sold yet, and that their average cost basis on SPX is 41.63. So if they haven't sold yet, why would they still sell? So if we do sell off, are those people going to get shaken out? Probably not, especially if they know everybody's hedged. Two, all those hedges have been there for a long time, dude. So it's like as soon as they get a chance to cash in on some volatility, I think they take it. So it gets bought up again.
No, you're totally right, because they're going to know it's not getting close enough to where it needs to be. And so they're going to seize that opportunity to at least recover something off of those 360s.
Correct.
The fact that we have those 360s all the way down there is actually providing us with support until at least that December 16th.
100%. Yeah, that's why I keep saying, even if we don't spike on Wednesday, which is a very good possibility, we don't even see a big move. Just because it's like, can we really vol crush the 360s? I think those guys come off slowly, but the big vol crushes usually come from the closer expiries and the closer strikes. And so those have been there forever. So I don't think we could rip. We could, because there's a gap right above us, and that might be what takes us into the gap. But I think it's going to be a slow grind over the next couple of weeks to 420, as those 360s and those 380s
I don't
get charmed.
Fireworks to get us up there anymore.
I know, and it sucks because it's like we already know this is going to happen. This is the most likely scenario, and it's like I want fireworks, man. Where's the fireworks?
You know what? I like this combination where we started off talking about the GEX charts and did sort of a little bit of work unpacking them. Maybe not as thoroughly as we should have, but then moved into just talking about what we're seeing in them. Because I think part of the lesson is that at the end of the day, the best way to learn about how these things work is to be watching them and to be listening to these types of conversations, so that you can start to see what other people see in them, and then start to construct your own interpretation and pair it with the price action.
Correct. And that's the most important thing, what you said, pair it with the price action, because again, the price is the most important. It's going to be the one that determines most of the positioning. Two, it's connecting the options market to why people are making those bets. If you look at it more like a sports bet guy, like a gambler, a lot of people are into sports betting, and they're making bets on different combinations of scenarios or whatever. Okay, but they only have one way to do that. Let's just put their money in there, right? And so, and they just have some odds. This is basically that, but people have, a million different ways to place the bet. And what are those ways? I mean, I don't know. People just use fundamentals, or people are just, using RSI or whatever it ends up being. But all that gets combined onto one chart for you to see the bet. So it doesn't matter what the indicators they used or tools they used to place the bet. It's there.
Exactly. You see where everybody is.
And that information is, I'm just trying to build some depth for that information, just because it's incredibly powerful if you understand it, because it's taking the aggregate of the entire market's thinking process and putting it into a chart. And so it's like, well, That's what I said at the beginning, is like, if you change it from indicator to GEX, you basically just go, why would I have an indicator? Because it's like, that's just one little tiny sliver of the distribution. And you've got, you got 1,000 indicators, and you got a billion ways to use them. And then they all get put into one little, standard distribution chart for you. It's like, that's basically how it's changed my trading.
No, I think that's a beautiful way to put it. It's the perfect way to answer the question too.